The big U.S. banks are panicking as lending demand crashes. I'm your host, Steven Van Metre, and thanks for joining me today. And with interest rates rising, demand for new loans is crashing, threatening to bring profits of U.S. banks down with them. In today's show, we're going to take a behind-the-scenes look of how the system works and why the big banks are going to be driving interest rates to new lows. Let's pick the story up where mortgage demand falls to nearly half of what it was a year ago as interest rates continue to rise. Mortgage demand continued to crumble last week as mortgage rates climbed to their highest level since 2010. Total application volume fell 5% last week compared to the previous week, as nearly half of what it was 1 year ago, according to the Mortgage Bankers Association seasonally adjusted index. And here you can see the refinance index, something we look at almost every week, has fallen to just above 1,000, and at the lows back in 2018, early 2019, it got into the low 700s, and at the current pace of this rapid decline as rates rise, well, we're going to be there in a matter of months. And the average contract interest rate for 30-year fixed-rate mortgages with conforming loan balance of $647,000, $200,000 or less increased to 5.2% last week from 5.13% for loans with a 20% down. 1 year ago, and here's the key part, the rate was exactly 200 basis points lower at 3.2%. And now you start to get an idea of why demand for loans is crashing, because people already refied or people purchased at much lower rates and they have no desire to refinance at a higher rate. Now, some people will be forced to because they will want to tap their equity, but overall, people won't touch it. Let's continue the story, because with rates now rising quickly after a prolonged period of hitting record lows, very few borrowers are now able to benefit from a refinance, just as I suggested. That demand therefore fell another 8% for the week and was 68% lower than the same week 1 year ago. It marked 6 straight weeks of declines in refinancing, and the refinance share of mortgage activity decreased to 35.7% of total applications. And mortgage applications to purchase a home fell 3% for the week and were 14% lower than the same week a year ago. That annual decline is now beginning to grow as housing becomes even more pricey. And as we talked about yesterday, with the probabilities that the housing market is actually going to see a price decline, a lot of it has to do with the lack of demand from borrowers. And all you have to do is look at the weekly data, and it starts to make a whole lot of sense. Without demand, well, there certainly isn't going to be people driving prices higher. So how does this all fall back to the banks? And why does this lead to the banks actually bringing rates down? Well, first part is to understand that their profits are generated by lending. So when a dollar comes into the commercial banking system, they have two things that they can do with it. They can either lend it out, which is the ideal scenario because banks make the most money when they lend. And if they can't lend it out, well, then they have to pay the depositor interest. So they have to use the customer's money to purchase some form of interest-bearing security. And by regulation, that's limited to U.S. Treasury securities and mortgage-backed securities. So in a sense, the banks are buying bonds with customer money. And so when you start to see that deposit growth is outpacing lending, well, it tells you what the banks have to do. And let's take a look at this chart from the St. Louis Fed database. Well, we've got deposits of all commercial banks in blue and loans and leases and bank credit are all commercial banks in red. Also adding on their bank reserves of depository institutions. And you notice the lines are fairly together for the most part, except now there's this huge gap. And what does that imply? The banks have more on deposit than they have loans and reserves. So what do banks have to do? Well, they inevitably have to buy bonds because they have to back those deposits. And it makes a lot of sense. So when we start looking at lending demand, which is really critical, what you start to see is if there's a slowdown, how the situation changes. Now let's go take a look at this week's H.8 report, and you'll see loans and leases and bank credit are sitting at 11 trillion at the large commercial banks. So this is a number that's been rising, but should it start to slow down, well, that's where the problems begin. And why does real estate matter? Because real estate loans are around 4.9 trillion between residential and commercial real estate. And even though we saw in the bank earnings this week talk about how great credit cards were. Well, credit cards, the number in terms of dollar amount in loans is really minimal. The banks make most of their money on these big home loans, big commercial real estate loans. And if you've ever bought a home or got a loan, well, you know, because they're making a lot of money. You can see it in the numbers. And so you start to put this all together of what happens is when the economy slows down and you start to see borrowing demand go away. So what happens? Well, people are still making payments on their loans. This is something I want you to understand, is that every month or every quarter, whatever their interval of their loan payment, that's still occurring on all that $11 trillion of existing debt. Now, when you make a payment against a loan, your principal payment is removed from the monetary system. It's gone. It goes away. That's how it's accounted for. It is the interest that stays in the system. So when you go back to the 1970s, one of the reasons inflation was so difficult to deal with is because interest rates were so high that all this interest, it didn't matter. Someone paid off the loan, the interest still stays in the system, and there was just such a large amount of interest being paid that all this money clogged up the system. Today, we don't have that. So as demand slows down, what will happen is money will get destroyed. And there's not a lot of interest to leave it in there. And that means the banks now have all of these deposits. So every month you see as payments are being made, what happens to the deposits that had loans backing them? Well, now they don't have anything. So what do the banks have to do? They have to buy bonds. And this is critical to understand because we hear all the time that rates can only go up. You know, they're going to go 5, 6, 10, 20%. People just believe that rates go up. But when you understand how the banking system works, what you realize is as soon as demand goes away, and deposits continue to rise, the banks have to buy bonds. And by buying bonds, what do? They drive interest rates all the way back down. In fact, that's why you tend to see during periods like this when investors don't want bonds at all and say, I'm not going to touch them, the banks are buying them up like crazy because all they have to do is drive rates back down as demand goes away. And then what's going to happen is there'll be a demand for those bonds at a much higher price and they will sell them back to the market and make a tidy profit. And so what happens now is investors, retail investors in particular, see a big decline in bond prices and they look at their statements and what do? They make the biggest mistake that investors tend to make. They sell at the bottom. But one thing I want you to understand is when you know how the system works, that these big sell-offs are usually bought by the banks because they have no choice. In fact, now it gives you a little bit of insight to my strategy Portfolio Shield and why it hedges with bonds. Because what happens during recessions? What happens to lending demand when people lose their jobs and the economy slows down? It goes down. And the banks have to buy bonds. I'll put a link up there in the corner. If you haven't checked it out, be sure to. There's one in the description below. Now let's continue on with this because I want to show you now where bond prices are going to go. But we're going to pick up a different article, this one from Bloomberg today, as treasuries approach pre-pandemic norm with real yield above zero. As the 10-year TIPS yield climbs above zero as bond self extends and traders continue to bet on aggressive Fed rate hikes. The Federal Reserve's aggressively hawkish policy stance has driven a remarkable turnaround in 10-year real yields, which were below -1% in March after Russia invaded Ukraine. Fed officials raised their benchmark rate by a 0.25 percentage point last month and are signaling a relatively rapid pace of rate increases over the rest of the year. And here you can see in a chart that real yields, according to 10-year TIPS, are back off at zero and perhaps even touching into positive territory today. This is saying that we're moving well beyond the pandemic crisis and the monetary policy settings deployed to fight it and are now moving back toward more normal levels. The aggressive rise in 10-year yields has primarily been driven by higher real yields rather than higher inflation expectations. Now, when I think of real yields, I don't really look at TIPS. But what I like to do is express them by taking nominal yields, so 10-year nominal yields, and subtracting the year-over-year rate of the consumer price index. So let's take a look at that chart and see what we can learn and figure out where perhaps yields are going and where inflation might be headed. So here is the chart of real yields, nominal less the consumer price index on a year-over-year rate of change. And I want you to notice that when it's deeply negative, so here you see black is a zero line, deeply negative here in the mid 70s and here in 1980. And now, notably, these are periods marked by recession. And of course, no one thinks we're in a recession now, but who knows, history may show that to be otherwise. But what then actually happens from these deep levels with yields? Well, let's overlay and kind of pull out of the data the 10-year treasury part of this component, and we'll leave the blue the same. And notice that when you see this blue line at deeply low points, that you tend to get a peak in 10-year treasury yields, and then they go down. Now, it doesn't suggest that this is the peak in yields, or that real yields can't go lower. It just, when you start to see this, a peak is not far off. Now here you can see in 1980, it had a little farther to go, and then yields came crashing all the way back down. Here you see a dip in real yields led to nominal yields going down. Here you see another dip, and nominal was a little lag, but it went down. Then you see another one, they went crashing down. Here you see another one, and they went down. And now you see this really deep level, and what do people believe? Of course, they believe the same thing they always believe, and that's rates only can go up. But what's the real part of this data series? Well, now let's pull out the CPI, because it tells you actually what's really about to happen. So now taking the same real yield chart in blue and pulling out the CPI, what we find out is that where real yields bottom, wherever that is, consumer prices tend to rise. And what you can now extrapolate, and you see all these different areas here, is, of course, blue is real yields, red is a CPI. So bottom here, top there, bottom here, top there, is that at some point now, when the bond market starts to turn and head lower, what it's telling you is the CPI is about to peak. And of course, that means for bond investors, that's where you make the biggest return. So I hope you understand and have learned something in today's show that, if you have bonds in your portfolio, and most people do, the big mistake retail investors make is they sell because they don't understand how the system works. But when you understand how the commercial banking system works, and why their profits are directly affected by a lack of demand, that their only recourse is to drive rates lower, and it's aided by the fact that they have to back deposits with bonds. And so I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.